I wanted to do this short video to talk a little bit about some of the great ideas in the investing. Best time to think is when, at least for me, is when I'm walking. So I'm just gonna talk a little bit about market conditions and opportunities, what we're seeing out there today in the world of investing in real estate. So in another video, obviously, I talked about the fact that there's significant need for mass financing. Rescue and recovery capital is where there's a great phenomenal opportunity. Our funds participating in that, both Tempo Advantage and Tempo Income. We love the strategy. But there's also a safer part of the business where you can participate. Instead of doing mass financing, you can still do primary debt. Lending in this environment is a great business. Why? Well, because the interest rates are still high. And as the rates fall, or there's an anticipation of the rates falling, market conditions should actually improve for valuations. So if you're a lender and you're loaning on a property at a certain LTV, loan to value ratio, your position as a lender will get better as interest rates fall. Why does that happen? Well, because greater safety that the loan will have. As interest rates fall, generally speaking, capitalization rates fall and valuations improve. This is real estate 101. We saw the opposite when the interest rates spiked. Cap rates expanded or increased and valuations fell. And now, in September, the first cut is locked in. Most likely, we're going to see at least a quarter. And then post-election, more cuts and into the next year. So valuations are expected to improve. Cash flow is supposed to improve. So lenders' protection mechanism in first lien loans and mezz loans is expected to improve with falling interest rates. So investing in income-focused funds that do lending or participate in equity of real estate, interestingly enough, now is a great opportunity to participate for the reasons that valuations expected to get better, cash flow is expected to get better. It's almost the opposite of what happened when we were at the peak of the market. We're now effectively approaching or near the bottom of the market. We don't know when the bottom is formed. So it's very difficult to understand when the peak is formed or the bottom is formed until time passes. So what we do know today is the peak of the market was middle of 22, when the interest rates started to climb, but the market was still had about another year of interest rates hikes. If you remember, Fed continued to hike all the way through July 2023, and they started in March of 22. Now the reverse is true. They haven't started cutting, but there's already forward expectation that the interest rates are going to come down. To what level, we'll see. But the Fed funds rate stands at 5.25, 5.5, and the sort of neutral rate, or at least normalized interest rates, maybe somewhere in the let's call it 2.5, maybe even 2% range. It depends. So there's a lot of room to go down, and that should be significant support for many projects. The real estate trades on leverage, and falling interest rates should be significant tailwind, as we discussed. So, great opportunities today. It's a great time to be a lender. Other two opportunities I talked about. So you have primary debt, first lien loan, conservative underwriting, great interest rates. You could charge today in hard money loans. We charge 14%, a few points, right? Before it used to be 12, 11. Now we're still at 14. Over time, it might come down a little bit, but it's still great opportunity. Now in the mass financing, we're doing loans at 20%, and a risk-adjusted basis feels absolutely phenomenal because of the it's equity-like returns without equity-like risk. And the next opportunity is deep buys. So folks who have been hurt by investing in 2021, 22 at the peak of the market, may be very discouraged, nervous, concerned, cautious to put in fresh money into the real estate today. That is known as a recency bias. absolutely understood and respected their opinions and concerns. And they're valid, but it is a recency bias. And the most incorrect thing to do is to buy high, sell low. Most people do that. Unfortunately, it's the mentality. It's how people throw money at the markets when they're at the peak. And the reverse happens. I have conversations with folks who are so happy about the stock market, they're thinking it's awesome, it's going to continue its great run. And I don't know, maybe it will. But it's at the peak, it's done well. So it's time to be cautious with investments that have done really, really well, and consider value investing, what Warren Buffett has done, or continues to do, and essentially be greedy when others are fearful, and be fearful when others are greedy. So the forward opportunities in commercial real estate on both debt and equity side today look better than ever before. Well, in the recent history, let me put it this way. So based on the current market cycle, we are deep in the recession and probably going to start the recovery soon. It might already have started, we just don't know that. When we look in arrears, we'll see. Although the forward projection is that the recovery may start early part of 25, but the idea is not to catch the bottom of the market, because you don't know what it's formed. Directionally, we know we're near the bottom, maybe already past the bottom, and that's the time to consider writing fresh checks in both equity and debt of commercial real estate, simply because of the risk-reward profile has significantly changed, and the income opportunities today are strong because the rates are high. And when the rates fall, the opportunities may be more equity focused. But today you can start by lending, participating lending funds. So income-oriented strategies with strong underwriting and good sponsors and borrowers is a way to participate today, and be prepared to shift into some equity participation on deep buys when these deals start happening. So it's sort of if you study market cycles, these are the best opportunities during a recession recovery parts of a cycle. They are cautious, conservative lending, low leverage, relatively low leverage, and then on the recovery side, it's beginning to participate in the deep buys, a little bit of increased leverage as banks may start opening up. We're not there yet, of course, but forward-looking, this is where really interesting opportunities will be happening. So how folks participate? Well, it depends. You can obviously do your own deals, but a lot of folks prefer to participate through funds. And on our side, in Tampa Family of Funds, our primary focus products on both primary debt and some mezzanine debt are Tempo Income and Tempo Advantage. Tempo Income is focused on more lending, primary lending, some equity deals too that are income focused. And Tempo Advantage Fund is all about mass financing, mass debt in this environment. So that's about it. Feel free to reach out. Until the next time, I appreciate you. And once again, enjoy Chicago Riverwalk. It's beautiful. If you're here in the summer, it's a great place to go by the Chicago River. So have a great day.